Welcome everybody to the 4D Finance channel. And in the news here a lot recently with the uptick in the China trade situation, there's a lot of people speculating for a stock market dip, a bigger one than we recently had over the past couple days. And you just hear a lot of folks talking about the concept of a recession or a stock market crash. It's all over YouTube, trying to predict when the next one will come. And I sort of pay attention to this as sort of a thermometer because I'm always excited at an opportunity to buy the stocks that I like at a discount. So I look at a dip in a different manner. I look at it as an opportunity to buy. And so I sort of pay attention to my own metrics. And the metrics that I'm looking at here today is the VIX Volatility Indicator. So we're going to jump into that today here on 4D Finance. All right, if you're not familiar with the VIX, you'll hear a lot of it on stock market news sites, and it's just basically a general indicator of volatility that a lot of traders use to gauge how unstable the market is at any given time. So looking at the Investopedia definition, they say that the VIX is a real-time market index that represents the market's expectations of 30-day forward-looking volatility. It provides a measure of market risk and investor sentiments. It is also known by other names like fear gauge and fear index. And portfolio managers look to VIX values as a way to measure market risk, fear, and stress before they make investment decisions. So long story short, it's a way to kind of project the future in terms of volatility. It's not always a one-to-one ratio, and it can spike quickly in terms of news coming in. It can take an immediate jump or dip depending on what the news is, but it's a good way to keep a pulse on the stock market. This chart here looks at the S&P 500 versus the VIX over the past couple years since May of 2017. And this chart sort of personifies why I'm not super concerned about a market dip right here in the month of May or in the month of June unless a lot of things change. So you see here that the last time the market did a huge spike, which was in January of 2018, so you had the VIX going all the way up to 35, 37 on its scale, and you had a price increase. On the flip side of prices going up, you can see the last drop, which started in October with the trade concerns and eventually reached a peak on December 24th. You can see that as soon as those October numbers started coming in, that the VIX jumped up pretty considerably from around a 12 or 13 all the way up to a 25. And in some cases, when we got to Christmas Eve, the VIX jumped all the way up to 36. So a lot of volatility in the market over those last couple months of the year. And as a matter of fact, this chart here from Index Indicators has standard deviation points for the VIX. So beginning in October, if you took the mean average of 9.82 for the VIX, we jumped 1 or 2 standard deviation points beginning in October, riding all the way through December 24th. On December 24th, you jumped all the way up to +4 on the standard deviation score. So we were way out there on volatility. But as you see, when prices started to return on the upswing, shortly after the start of the new year, volatility settled down quite a bit. And right now, we're hovering in the neighborhood of the mean. So actually the mean is 14.5. I think I said 9 something earlier. It's 14.5. So since February, we've hovered right around the mean at 14.5. On May 14th, when we had the big drop, when the China trade fears spun back up and the president's tweeting and all those things, we had a jump all right, but it was only up to about 20 on the VIX scale, which is just at 1 standard deviation point. And already I'm seeing that the VIX is coming back down. So I think last time I checked, it was in the 18 range. Obviously, it changes every day, but it's already settling back down. And that volatility thermometer to get to a 20, generally speaking, while that can rock some things, and obviously we saw some price dips involved with that, it was never close. It was never close to a full-blown recession. It was never close to a gigantic drop in the market. That doesn't mean that you can't turn on the news tomorrow and we wouldn't see something else happen. But for right now, we're hovering in a pretty stable place. This chart compares the VIX to the Nasdaq 100, which is one of the ways that I tend to follow the stock market, because I believe in a lot of companies in the Nasdaq 100, and I think it represents the best segment of growth in the stock market in the United States. So when you look at the VIX from that scale, we see here that the Nasdaq 100 has been relatively unimpacted by volatility, okay? Because a lot of these companies are continuing to just print money, whether it's Facebook, Google, Microsoft, Adobe, you name it. They're just dropping dollars all over the floor. So you can kind of get a feel for the difference between the S&P and the Nasdaq 100, right? Where does volatility hit? And in the S&P 500, you have things that are manufacturing, you have energy, you have transportation, and Nasdaq 100 has some of those things as well, but they're significantly less impacted by news of a trade war, and they're significantly less impacted by the concept of volatility because most of them have really strong balance sheets. So that's not to say that when the VIX goes up, as you see on December 24th and most recently on May 14th, you see that there is a correlation between VIX going up, price coming down in a lot of cases. The spread of impact is much less for the Nasdaq 100. So the bottom line here is you should watch the VIX every day, not all day, every day, but put it in your stock market watch list, get a feel for where it's trending, and a lot of times you can be on the forward end of predicting the next quick flash or quick dip, and gives you an opportunity to prepare your money to buy some stocks if the results turn out the way you like. Again, I want to stress it's not the end all be all for predicting the next recession or whatever, but as volatility starts to rise in the market, you have a much higher chance of large ebbs and flows. So to put a VIX in your watch list on your favorite stock market website is a pretty easy thing to do. And it gives you some sort of demeanor of your own when it comes to interpreting the news that you see on the television. So hope this helps, guys. If you haven't already, please subscribe to the channel. I really appreciate the positive feedback we've been getting, and I'll see you on the next video.